Stock futures a little changed right now. Bond futures also a little changed, a bit into the dollar, but a focus today on the Fed that will compete with our big tech conversation. Joining us for some macro thoughts, Danielle DiMartino Booth, CEO and Chief Strategist for QI Research. Great to have you. Good to see you this morning, Danielle.
Good morning, Oliver. How are you on this Fed day? You're right. There's going to be some competition coming up at 2 p.m. Eastern.
Yeah, what do you think? Powell going to be splashy, or is he going to be calm and quiet?
I think actually that the goal today is for him to do as little to the markets as possible. We've seen quite a nice rally in the bond market. In fact, despite seeing a 75% retracement in tech losses from Monday on Tuesday, you know, the 10-year benchmark yield managed to stay pretty low towards the 450 area. And I think that markets are planning on Jay Powell not being Dirty Harry Jay Powell. They're planning on him being calm and intimating that he's going to be data dependent and that a March rate cut might be on the table. He's going to be
end of Gran Torino, not beginning of Gran Torino. Clint Eastwood, maybe.
Good way to
I wonder who in that conversation Christopher Waller is. I mean, how will his follow-up be to those very dovish comments from 2 weeks ago? Because that was like the last time we heard a major like Fed speech move the market. And it kind of seemed like since then, bonds have been pretty continually bid.
They have indeed, and Waller, as you rightly point out, is considered to be kind of the closest confidant on the Federal Open Market Committee of Jay Powell, and his comments really were followed up by a release by the Cleveland Fed, their new tenant rent index, and Waller spoke specifically to the weakness in using imputed shelter and that the Fed should rather use more real-time metrics. And then the Cleveland Fed new tenant index went from 1.6 year over year in the fourth quarter to negative 2.4%. So that really is, it was Waller mentioning it. It was Jerome Powell mentioning it at his December 18th press conference. We'll see if he follows up by saying that they're following market metrics that are a little bit more real time, as opposed to kind of imputed arcane owner's equivalent rent that really moves a lot more slowly than where the market is right now for shelter, which is 46% of core PCE. You have to pay attention.
I mean, that really is kind of the debate, it seems still, housing data and how quickly it's going to kind of disinflate as the numbers catch up a bit. That seems to be the pushback I get from folks who say, hey, look, the inflation, numbers are misleading, right? A lot of it comes down to housing.
A lot of it does. And, we've seen 500,000 apartment units nationwide come online, come out of the construction pipeline in 2023 and in 2024. There's at least another 500,000 coming out in 2025. And we are indeed seeing, it's just the law of supply and demand. We are seeing rents in real time come down. And I think that that's what's got markets encouraged in terms of future Fed rate cuts, as well as when you get conference board data out like we had yesterday, where you've got the majority of Americans expecting a weakening in the job market, that also will get the Fed's attention. That's certainly going to be a subject of discussion at today's meeting before the statement's released.
We saw mortgage apps this morning looking pretty soft again, which I guess speaks to the point of the need for supply and perhaps some reduction further in prices. In terms of the other data they're looking for, Danielle, for jobs or employment, do you think that, well, I guess I should also say like inflation expectations the last couple of readings were fairly sticky too. So if Powell does choose to be a little bit more balanced than Waller, what type of data do you think he balances it with if he says, look, we don't need to cut right now?
Well, you're right to point out inflation expectations, and to see in one survey, University of Michigan or Conference Board, but to see conflicting directions from the perspective of households, where they're saying, well, we expect inflation's going to rise in the future. A lot of that is headline risk that's emanating from the new Trump administration and concerns that we have about tariffs and the fact that households, U.S. consumers remember the last time that the trade war did end up manifesting in higher goods prices. But that's a real conflict with concerns about losing one's job. And, I always tell people that when it comes to something as important as housing, there is one thing that is more important than mortgage rates, and that's whether or not you anticipate having a paycheck.
Okay. Danielle, what then do you see as the path here most likely for their timing on cuts? Take me through the trajectory that you think we're going to get this year.
So, just using a very simple one-factor regression based on consumers saying jobs are hard to get, that implies that the unemployment rate should be closer to 4.6% compared to the 4.1% that was released most recently. So I think that Powell is going to be very definitive in saying, if we see further weakness in the labor market that validates households' concerns, then they're going to be leaning more on that labor mandate as opposed to the inflation mandate. And again, we're going in with about a 33% chance, you've got it up on the screen right now, of a March rate cut. I could certainly see that moving up to 50% here in the weeks that come if we continue to see, 3-year highs in continuing jobless claims and an increase in the unemployment rate.
The reaction if we get cuts that are in line with what the market's been pricing right now, Danielle, do you think that keeps bond yields from pushing higher? Or if the Fed keeps cutting, do we see the September to December trend where Fed cuts and yields go up, curve steepens?
Well, I do think we are going to continue to see the curve steepening, but I think that it's going to be more a factor of the market pricing in more than 2 rate cuts in 2025. So I think we're going to see the short end of the yield curve, the 2-year Treasury note yield, come down further. But I don't anticipate too much upward pressure on the longer maturity 10-year note, simply because we know from our experience in 2018, 2019, that it takes a good year before we see tariffs show up in higher goods prices.
That's a big element of this for many folks' analysis, trying to figure out tariffs. How directly do you think Powell and team can model that stuff out when so far we've kind of heard mostly rhetoric, like even in the first swing of executive orders in the pen, like tariffs are not there yet?
They're not there yet, and that's true. But Oliver, I really don't believe in coincidence, and I don't think that there was any coincidence in the Fed's Public Affairs Office releasing 2019 FOMC transcripts. They're released with a 5-year lag. They were released just a little while ago, and it basically walked through the episode of the 2018-2019 trade war and how that ended up showing up as negative global trade for the year. I think they're trying to say that by releasing 2019, here's our game plan if Trump really does push forward with tariffs. And of course, we could see this as soon as February the 1st in terms of what's being threatened for Mexico and Canada.
The other element perhaps under discussion here is Fed balance sheet, QT. How much does that move the needle, Danielle? Where does that rank in this conversation in your mind?
Well, I don't, again, think that there's any coincidence in there being a lot more focus these last few days on whether or not the Fed is going to finally start to comment on the balance sheet quantitative tightening, when they're going to stop the roll-off of treasuries from their balance sheet, if they're going to lean harder on mortgage-backed securities roll-offs to make up for low prepayment speeds in recent years. So I think that the media today in the room is going to be very forthright in asking for Powell for more details about what the Fed's plans are. We have seen major Wall Street banks push back their anticipation for the end of quantitative tightening, really from May, June now until September, October.
Okay. All right. Love it. Good setup. Anything on your radar economic-wise? Give me the update on kind of your overall economic vision, Danielle. Do you think these efforts from the Fed will stave off worsening in the economy?
Well, I certainly do think that that is the hope. U.S. consumers are still battling with some of the highest interest rates on record, whether you're talking about credit cards or auto loans. So I think that there is definitely relief that is wanted by the U.S. household sector. By the same token, of course, we're going to have a little bit of downside to the fourth quarter GDP report that we're expecting out this tomorrow morning, specifically because the trade deficit did come in so much higher than what was expected, which will detract from GDP math. So it'll be interesting to see whether or not we continue to see cross currents in the data. Of course, we've seen some strong regional Fed manufacturing surveys. Are we going to see an upside in ISM as well? A lot of data coming out between today's meeting and when the Fed meets again on March 18th.
Okay. All right, so we're looking for Powell to try and toe the line, be a little bit more balanced than Waller, but still get us ready for March cuts. Kind of sounds like the plan.
I think that that's what to expect today.
All right, great stuff. Danielle, thanks a lot for being here. Appreciate your time.
Thank you for having me.
Absolutely. Danielle DiMartino Booth, CEO and Chief Strategist for QI Research. Right, nice. There it is. A very full look at all the elements for the FOMC this afternoon.